Good morning. Welcome to Trading Hour. We're coming to you live from the CNBC-TV18 Motilal Oswal studio. I'm Reema Tendulkar. With me is Hormuz Fatakia. The Nifty's climbed above 25,600. It's a 125-point up move on the Nifty. The Sensex is raced away with a 400-point gain, and it's IT to the rescue on the way up. So frontline IT names like Infosys, HCLTech, Wipro, TCS seeing buying. Infy is your top gainer, 2.7% up. But generally, the recovery in the last 1 hour is courtesy the large cap IT names. Asian Paints reports numbers later this week, and that's come in for some amount of buying. And the stock, in fact, has hit a fresh 52-week high. Bajaj Finance reports numbers later today, and that stock ahead of that is also seeing some traction on the way up. On the way down, its trend, which is subdued, now taking its year-to-date loss to 40%, and it's a fresh 52-week low on trend as the stock struggles with competition, slower growth, consumer sentiment has been subdued, and perhaps some cannibalization as the company continues to add new stores. But Hormuz has now moved over to the big wall to tell us about the top movers and shakers in the market right now. Hormuz.
Well, earnings reactions are aplenty, but to talk about the buzzword of the morning today, and that has been Lenskart, and it's been a very impressive recovery from the opening lows. The stock fell as much as 12%. Now it has back at its IPO price, and the shares worth over 3,000 crore rupees have already been traded in the first hour of Lenskart's trading debut itself. So significant volumes, almost well over 7 crore shares have been traded already. HBL Engineering is an earnings reaction. It was off the highs of the day. At one point was up almost 13 to 14%. It's the biggest single day gain in 3 months. The stock has gained in 3 out of the last 4 trading sessions as well. We've had over 1 crore shares that have been traded for HBL Engineering. The 20-day average is only 6 lakh shares. And the stock, as a result of this move, it's above all of its key moving averages. And at the end of 2022, since the end of 2022, the stock is up almost 10x in value and has been delivering positive annual returns since the start of 2020. On the downside, transformers and rectifiers, multiple news flows resulting in that 20% lower circuit, but the street may have had a whiff of this. The 7th straight day of losses today, as the stock is down 32% in the last 7 trading sessions. And in this lower circuit, we have had close to 30 lakh shares that have been traded. The 20-day average is only 2 lakh shares, and this is already turning out to be the worst month for the stock since October of 2008. And lastly, Nalco is a positive earnings reaction among the PSU names. It's a strong reaction to its second quarter results. Over 1 crore shares were traded on Friday. More than 1 crore shares are traded today as well. In fact, we have had close to 3 crore shares that have been traded on Nalco today already. The 20-day average is close to 50 lakh shares and 20% higher so far in the month of 2025 so far. And that comes on the back of a 60% gain each in 2024 and in 2023 as well, Reema.
Thank you very much for that. But Lenskart is clearly the big story of the day, and we'll put the spotlight on the new kid on the block, the recovery that we're seeing in today, though the debut was muted. We now can go across to Mangalam to tell us more about this. Mangalam.
Well, if you look at Lenskart, it was a very interesting story, the most talked about issue in very recent times, and rightly so, because it's a strong consumer brand. Their stores are everywhere. At the same time, the founders are fairly popular as well. And then you had the valuation issue. So it was fairly debated, hotly discussed, and then the listing was something that the street was expecting to be muted because of the value, on offer. At the same time, from lower levels, because the business is fairly strong, we saw the stock recover as well, and now hovering very close to its issue price of 402 rupees. The total subscription, there was a fair amount of demand for this issue. 28 times oversubscription, led by retail, 7.5 times, institutions, 40 times, HNIs, around 18 times as well. 7,300 crore rupees is what the company raised. But at the same time, remember, this is a D2C company that sells a wide range of eyewear products. They acquired Ondays in Japan, and that accounts for nearly 40% of their sales as well. In India, they have about 2,150 stores, and globally 2,800 stores. What they've basically done is close to around 1,900 crore revenue in the first quarter, with margins of around 17.7%, a net profit of 60 crores. And if you look at their strengths and the opportunity along with threats, 2.5 times bigger than their nearest competitor is what they are. The organized eyewear segment in India is projected to grow 60% higher than the unorganized and be 31% of the market by FY30. And they are expecting international expansion as an important instrument of growth going forward. Going forward, the question is at what price? Because there is strong growth runway. 30% plus is what the company has been growing at. Indian market is likely to grow between 12 to 14%. The company has said they'll grow 2x of that. And even if you annualize the first quarter profits, it's trading at close to around 200 times price to earnings and over 8 times price to sales. So that's something that the street will constantly keep discussing.
Of course, has been the subject of much discussion over the last couple of weeks. Mangalam, thank you for that update. In fact, we did chat with Piyush Bansal of Lenskart at the Global Leadership Summit. Listen into what he had to say.
I think it is time that we start creating global brands, because my firm belief is that in the long term, if you think 10, 20 years, either you are global standard or you may cease to exist. What will it take for us to create global companies? I think the most important thing is belief. But today about 40% of our revenue comes from international markets. I think that belief was really important. What we have achieved so far is a very small portion of what we intend to do. We want to give a vision to 1 billion people. We have given it to only about 25 million people so far. Right? So there is a lot more to do ahead. And I do think game is going to be about how do you leverage technology, and this is my firm belief, to solve some of the biggest obstacles in getting access and affordability to people, right? Because what are the two important things? One is how do you deliver great experience? And second is how do you deliver it most efficiently? And in both of these, technology has a very large role to play.
We'll take a short break, put the spotlight on the crypto markets. On the other side, Manisha Gupta joins in.
CNBC-TV18 presents Crypto Corner, powered by CoinDCX.
Welcome back, and as promised in crypto space, we will talk about the crypto markets right now, where we have seen continuous decline or profit taking into this space. Well, remember, the first half of 2025 was all about gains. It was about the US president coming in, new regulations, and a lot of friendly frameworks come in. But the second half clearly has been more about profit taking. So when you look at Bitcoin itself, it has been down 20% from its all-time high that it saw on 6th of October at around $126,000. It's trading at around 105 to 108 right now. Interestingly, on Friday, it also saw a decline below 100,000, and we did see those lows at around 96,000 to 97,000 as well. Now, this has happened second time in a month that the Bitcoin has tried to break below $100,000, and the markets do believe that that could lead to some bearishness for the markets there. It also has to do with the early adopters in Bitcoin, which seem to be selling their large holdings. Also, when you look at the last 2 or 3 months, it has been more about the leverage positioning, where we have seen profit taking come in. Since the month of July, it really has been about massive liquidation. The leverage positions liquidation also happened in the month of October. And then since July, there has been a lot of pressure coming in. The Bitcoin also is looking at the US dollar index, which has seen some strength coming at around 100 levels, and that has been putting pressure on various alternate currencies there. Researchers do believe that if you do see a break of around 93,000, then that could open way for 70,000 on the lower side as well. But there are various reports also suggesting that by the end of this year or in next 6 and 12 months, you could also be looking at 170,000 when it comes to Bitcoin there. That, of course, is a report that's coming from JP Morgan. So the street clearly is divided on where the cryptocurrencies could be headed in the next 1 year or so. But at this point in time, it's a sharp correction that we've seen from the highs of 2025. So Bitcoin, as I mentioned, has seen a sharp decline, 20% off onto that one. But that's not the only one. Take a look at Ethereum, 4,800 to 3,600 currently. From a high of 1,300, Binance also has slipped to 1,000. And we have seen a sharp correction in Solana as well, from 262 to 180 there. And Ripple, whether you talk about Polygon, Ashgrand, all of those cryptocurrencies which are looking at higher market capital have seen some decline come in. And as I said, the first half of this year was very, very bullish. But as you can see, the second half just about holding those kind of gains there. So Bitcoin is holding with 13% of strength right now. Ether is just about 9% higher. Binance Coin clearly has done well, but that also has been because of the mergers, acquisitions, stable coin strength that this platform really seems to be attracting right now. Solana actually is turned into negative, and you have Ripple just about holding 18% as well, with markets believing that the month of November and December would be quite deciding on how this year closes. And with that, that's all the time on this segment, but we'll come back after the break and talk about markets and stock specifics.
CNBC-TV18 presents Crypto Corner, powered by CoinDCX.
Welcome back. IndiQube Spaces is in focus after reporting the Q2 numbers. The top line for the company has gone up by 38%. The EBITDA has gone up by 74% on a year-on-year basis. Rishi Das, co-founder and CEO at IndiQube Spaces, is now joining in. Rishi, great to have you. This is Rima here. Strong performance in the first half of the year. As we said, 38% in Q2, but in H1, it's a 33% top-line growth, and adjusted margins are at about 21%. Can you sustain a 30% plus revenue growth for the full year and maintain margins at 21%?
Yeah, thank you, Rima, first of all. Yeah, I think, it's very sustainable. That's what we are seeing, that we have some good wins in the quarter. The basis that we are quite confident that if you look at the current quarter, which is going on the Q3 as well as Q4, we should be able to sustain the revenue growth and defend the EBITDA margin as well.
Okay.
Rishi, good morning. Thank you for joining in. Now, same about the occupancy levels as well. At 87%, you sustain that in the second half, or you see an increase in the occupancy levels?
Occupancy level will hover around a similar range. There could be some fluctuations because, as you can imagine, when we add properties, any new properties get added in a quarter, there is a slight blip. But what we have seen historically is that at a portfolio level, we have always been between 80 and 85%. And if you look at our steady state centers, which are more than 12 months old, we have been between 85 and 90%. So that's the guidance that we have internally. And there could be some fluctuations here and there, but it will be range bound.
Rishi, your AUM increased by 1.3 million square feet to 9.14 million square feet, and the seat capacity went up by 30,000. What is the guidance on seat capacity and AUM for the second half of the year? Where will you end FY26? And any indications for what FY27 might look like on these two?
So we have been adding, Rima, anywhere from about 100,000 square feet to about 125,000 square feet monthly. That has been our addition, and that trend has been fairly consistent. And we are very hopeful that we'll be able to sustain that. And if you translate in terms of seats, it comes down to about 2,500 seats. Typically, every month we should be able to continue adding. And we have a good headroom for growth. If you see, our AUM is 9.1 million, and out of which about 5.8 million is what is giving us the rent yielding. So we have almost close to 3 million square feet, 3.1 million square feet of space that is available to us. So that gives us a good headroom for growth. And we will be, in terms of growth, range bound between 30-35%. And we are quite hopeful with the kind of supply pipeline we have, we should be able to sustain that, yeah. Similar numbers should be there for FY27 as well.
Rishi had also highlighted that you have plans of doing capex worth over 460 crores in the over the next 3 years. How much of it is done in the first half? How much do you expect to do in the second half? If you could share a breakup of the numbers over the next 3 years.
So in terms of capital expenditure, most of our capital expenditure gets done on adding the interiors for our offices. And typically, if you look at like the H1, we would have added close to 100 crores worth of 120 crores worth of capex that we would have done to add more seats on a net basis. However, there are some past payments, future buildings that we sign up, for which we have to pay advances and all of that. But purely in terms of interior capex, it will be about 120, 130 crores that we would have spent in H1, and we see a similar outgo in H2.
What
and,
is the... Sorry, go ahead.
Yeah, and what we have budgeted the 3 year, we are very hopeful that this money should last longer with us because we have very strong cash flows. Typically, our cash flows have been almost like 150 crores in the H1. So that should be providing us a lot of accrual-based capex opportunity as well.
Rishi, I remember the conversation we did around the time of listing, and we spent some time discussing the contribution of value-added services. And that number was going up. And if I recollect, when we spoke, it was about 12.5%, 13%.
Yeah.
What does it stand at right now, and how are you looking to increase it? I mean, do we have a target in mind?
Yes. So if you look at Rima, a year back, from there on, it was 11%. Now we are at 13%. So there has been a 2% growth. And as you can imagine, when we have grown by 33, 34% on an overall revenue basis, growth from 11 to 13% is a good growth. We are quite confident that this number will start touching 15% in next year. And why we are so confident is because we are finding that when customers are coming to us, they are buying more and more B2B and B2C services like food, transport, IT infrastructure, green power, the like. And also they are giving us the opportunity to serve their other centers, which are beyond IndiQube centers. So for example, if they have taken space in a couple of offices with IndiQube, and if they have 5 more setups, the other 5 setups also they want us to make them IndiQube managed, where they expect us to provide services. So that number, we are quite hopeful that will continue on our upside. And for next year, we see this number reaching close to 15%.
Rishi, is there a supply constraint in the market currently? Because a lot has been said about commercial real estate in comparison to the residential bit. But in case there is a supply constraint, which geographies are facing this, and what's the situation right now?
So definitely, you are so right on that the absorption has been very, very sharp. Typically, like in the 9-month period, calendar year, India has absorbed close to 60 million square feet of space. And this compares very well with the last year numbers. And just the quarter, the Q3 calendar year, absorption has been close to 20 million square feet. So there is a supply crunch building up. Cities like Mumbai are facing quite an extreme supply crunch. In certain pockets in Bangalore, we are seeing the supply crunch coming in. But as I said earlier, that we have a good headroom of almost 3.2, 3.3 million square feet of area which we have signed up and yet to become rent yielding. So that should ensure that in the short to medium run, we have enough supply. We are signing up new buildings. Plus, another distinguishing factor with us has been we have done a large amount of renovation. If you see, close to 3 million square feet of office space in our portfolio is renovated buildings. These buildings are which were done, say, 30 to 50 years back. For example, if you see today Nariman Point kind of location, with the C-Link coming in and metro getting started in some time, you will see a lot of revival in Nariman Point kind of area of older properties. So we are seeing the same kind of revival happening in many Indian large cities like Bangalore, NCR and all of that. So since we have been an early mover in picking up the older buildings and renovating them, we see a large part of our supply should come from the existing stock. We are not completely dependent upon the new stock coming in. And to give you another idea, India has about 1 billion square feet of real estate, and 500 million real estate is more than 10 years old. So there is a massive opportunity to also tap into that pool of supply.
Rishi, thank you for sparing time and joining us today. Wish you good luck for the second half of the year as well. And while the index continues to do well, good time to get in an F&O check as well. Mangalam joins in with the latest trends. Mangalam.
Well, the indices continue to do well at the higher end of the range today for the Nifty, above 25,600 as well, taking its total gains from Friday's low to well over 300 points. And the good part is that, well, Friday, the recovery was led by the Nifty Bank, which rallied about 800 points from lows. Today, the recovery has been sustained by IT index, which is actually taking the index, the frontline index further. The Nifty Bank, if you look at the other indices, is actually an underperformer right now. In fact, as we speak, the Nifty has also gone ahead and crossed the 20-day moving average of 25,639 It's closer to 25,650 right now. So that's something we will watch out for, because if the market sustains at these levels, then there could be a case for powerful short covering. Why do I say that? Because, despite the Nifty recovering from lows, we've actually seen the FI longs come down from a series start of 20%. In fact, even at the last 3 trading sessions, the FI longs are down from 15% to 14% to now 13%. So 87% of their shorts are, in the system right now. With the Nifty moving back above that 20-day moving average, will bulls make a comeback or not is something that we will track in the second half. Nifty Bank will be extremely crucial to watch as well. While the Nifty has moved higher, as have put writers gotten their confidence. So 25,600 put fairly active in trade, 25,500 put equally active in trade, telling you that there is strong support at around 25,550 to 25,500. But at the same time, the 25,650 and 25,700 call writers haven't left their position. So that's something that I will monitor, because if the Nifty stays between this 25,650 to 25,700 range, then the 25,650 call writer and the 25,700 call writers will have to cover their position. So that would provide an additional up move to the market, which may go all the way up to 25,800, 25,850. But a lot of stocks are, seeing some short covering. Nalco, for one, good results coming in. A lot of stocks stuck on the wrong side, so they are shutting their positions down. And then we have Trent, which is the top Nifty loser. A lot of shorts backing it. In fact, down about 12% in terms of its open interest. That's increased, and that's the kind of short build-up that we're seeing on Trent.
Thank you very much for that. Get into a break. On the other side, we'll discuss market fundamentals. Devang Mehta from Spark Private Wealth Management joins in next.
Welcome back. Good going for the markets, but with more highlights from the CNBC-TV18 Global Leadership Summit. The Principal Secretary to the Indian Prime Minister, Shaktikanta Das, says that the Indian economy continues to be sound, stable and resilient amidst the global uncertainties. He also reinforces that more reforms are in the offing, especially on the ease of doing business front. Listen in.
The overall, in the global context currently, when the world order is changing, when the rules of international trade are being rewritten, when multilateralism is being replaced by regional agreements and by bilateral agreements, given the current uncertainties all around, both geopolitical and economic, Indian economy continues to be sound, stable and resilient. That's the first point which I would like to mention. I can back it up with a series of factual details, but in the interest of time, I'll leave it at that. Second, the goal of Viksit Bharat, that is making Indian economy as an advanced economy by 2047, it's very much on track, and the Honorable Prime Minister has set the roadmap. You would have seen, just think of 2025, the kind of reforms which have been taken, GST, next-gen GST reforms which were undertaken recently. The Prime Minister talked about it on 15th of August from Red Fort, and within 5 weeks, on 22nd of December, the next-gen GST reforms were implemented with the cooperation of all the states. So the second point I want to mention is that the goals of Viksit Bharat, the roadmap has been laid. Several reforms this year have been undertaken, not only in GST, but also in non-financial sector deregulation, for which a high-level committee has been appointed. So in the days and months to come, you will see a series of reform measures relating to ease of doing business, relating to making Indian economy more competitive. All these measures will follow. So as the Prime Minister has pointed out on 15th August, I'm referring to that because that was really a moment which really marked a leap to the future. On 15th August, the PM PM stressed that reforms will continue with greater vigor. And thereafter, we had GST 2.0. Many deregulation measures are in the offing, and several other measures are in the offing. That's the second point which I would like to mention.
Taking the conversation on the markets forward with Devang Mehta from Spark Private Wealth Management. Devang, good morning. Thank you for joining in. You start off with Trent, though, as the earnings accident of the day on the Nifty stocks at least. You know, when a stock has been at the street getting used to almost 35 to 40% growth, that even 16 to 17% growth looks below par, seeing the stock reaction. But have valuations now corrected enough for it to be an attractive bet? From almost 8,400, the stock is now below 4,300.
On the show. Good morning to all the viewers as well. I think, see, probably what we have seen in Trent, and this has been the sector retail or sort of a discretionary consumption has been one of our sectors to go to. What we have seen in Trent particularly, and of course, the revenues, when the revenues decelerated in the last couple of quarters, it appears like that. But most importantly, what it is doing, the operational efficiencies, the automation initiatives, all are still making a lot of promise for the operating performance. If we look at the EBITDA margins, it is still roughly around 12.2, 12.3%, which is I think very good. Most importantly, the company commented about the like-to-like sales, which sort of decelerated a bit, and the same store growth, which we talk about normally in the retail, that was a bit slower due to maybe unseasonal rains or not so great a demand, because more so the demand in September started off on the back of GST reforms for very high ticket consumption. But whatever the company has guided about, I guess probably maybe a quarter of miss or so. But these are sort of, I will not say attractive valuations, but the correction in such companies normally provide you with good opportunities. The company was on track to start around 13 stores of Westside and around 40 stores of Zudio. So my sense, it's getting into a zone where I think it's trying to also eat out some of the competition. So as I said, at some level, probably maybe 5% correction from here on, it would start looking very attractive.
Okay, it's already at a fresh 52-week low with a 40% fall this year. So another 5% lower would put it closer to 4,100. And that, according to Devang, is an attractive entry point for Trent. What else, Devang, are you recommending for your clients to buy at this juncture?
Rima, what we are looking at, I think probably most importantly, if you dissect the markets, the last couple of months when we have seen a bit of a bullishness return back to the proceedings, I think with good macros, with a decent set of earnings. I will say this set of earnings were not as bad as the street predicted. But the stark reality is that only few companies have done very well. So on the bourses, I'm not talking about the results. The results of a lot of companies were good. But on the price action, most of the companies which have done well are probably sector rotation we have seen. It started off with maybe banks, then it came to IT, then a bit of oil and gas. Every week we are seeing the trend change in terms of which sector comes to the fore. What I mean to say here is the broader markets as such, a lot of mid caps and small caps, while your indexes are just very from a very near distance from the lifetime highs, all these companies are trading very low. So my sense that if somebody has the faith for the next couple of years, a good mix of large, mid and small caps being sector agnostic and market cap agnostic would do the trick. On the sector front, which you asked about, we are looking at a combination of discretionary consumption, as I talked about, where the GST effect will be more structural. Yes, you will not see this type of sales for the next 3-6 months. You would probably see a little bit of sobered down sales, but I think it augurs very well for the industry to be a part of discretionary consumption. Second is capex, which we always talked about. I think the capex is just, again, the government capex will not slow down much, and private capex should also come to the fore with most of the companies operating at 80-85% of capacity utilization. So I think sectors like power automation, engineering, manufacturing, all this will do well. And last but not the least is financials, which I always talk about, the intermediaries, the depositories, the AMCs, which mostly have seen good set of numbers coming so far. And I think with financialization wave on the rise, with penetration and density going to rise, these are sectors which one should sort of build in the portfolio.
But Devang, you mentioned discretionary consumption. Does consumer durables fall into that bracket as well? Because consumer durables companies, the commentary from them has flattered to deceive, to say the least, be it Blue Star, be it EPAC Durables, and a lot of others, and they have been smashed all through last week. Would FY26 be a washout year for these such companies, and would you recommend taking advantage of such a correction because there will be a revival in FY27 on a lower base?
I think for sure, there is a very good chance of a revival in the sentiment if you look at per capita consumption of anything, right from cars to consumer durables, and you can take segment wise the likes of the air conditioning to your televisions, and probably also the premiumization trend, right, from people graduating from a normal TV to a LCD to a OLED. I think most of these companies which are now listed, and there is an ample choice now, right? From I'm not recommending anything, but right from Havells to the LGs of the world to Blue Star and Voltas into different categories. My sense that yes, any weakening of the stock prices because of not so good numbers, and it can be a trend a couple of quarters. But I think October, November, December sales should have been good for most of these companies because whatever we saw and whenever you interact with companies like Vijay Sales and stuff, I think there was a relative bit of good sales which these companies would have done. Yes, maybe operationally they can have 1 or 2 quarters difficult. Most of these companies have also done their capex. But my sense, somebody has a 1.5 to 2 years view. These are attractive bets on a fall.
Devang, thank you for sparing time and joining us today. Looking forward to having you more often on the show. Take a short break. The management of Interarch Building Products joins in on the other side to discuss the road ahead and their second quarter results.
Welcome back. Interarch Building Solutions is buzzing in trade after reporting Q2 numbers. Stock has gained 4%. It's a 52% jump in the company's top line and a 65% increase in the EBITDA. Arvind Nanda, Managing Director of the company, is now joining in to talk more. Mr. Nanda, it's been a very strong first half of the year. Your top line growth is in excess of 30%. When we spoke to you last time, 3 months back, you indicated that Q2 is typically a bit volatile, so you'll wait by to see. So you were sticking to your full year guidance of 17.5%, though you did say you're likely to beat it. Now that H1 has been so strong and your commentary is saying that this growth number is sustainable, what is the revenue guidance for the full year, FY26, and also on the margins, 10% or 10% plus?
Thank you for having me on the show. Yes, you are right. We seem to have done better than we expected. I think the monsoons and the usual problems that we normally face in the second quarter or the first quarter, we managed to overcome them. And I think we have also increased our capacity. So a lot of our turnover depends on our capacity. So the order book is good. Even going forward, our order book is still very robust. So I think the ability to deliver more to our customers, to produce more, to deliver more, to erect more, I think that has helped us. So I think we should be now upwards of 17.5% that we had predicted, definitely. So maybe nearer 20% is what I think we have given as a guidance even in our investor call last week after having done so well. And we have the ability to achieve that figure. Normally the first half is a little bit more critical. I think we have crossed that criticality. Second half is far more predictable.
So why not more? In the first half of the year, your top line growth is 39%. Are you being conservative when you say the full year growth number will be 20%, or are there more headwinds? And on margins, 10%, or you'll do better?
Well, I think the first half of last year, when we compare, the base point is a little lower. In the second half, the base point is a little higher. So it could even be higher, but we are not predicting that because in our business, because it's all a customized building, things can still get a little delayed in some large projects or some projects, and it could be. So it can. We are definitely trying to go full out. We are not going to hold on because we gave a prediction. But I think the prediction should be conservative because things can go up and down. Margins should improve. I don't know whether it will touch 10%. We are doing a lot of investment into plant and factories. And consequently, like I mentioned before, for pre-unit building, it is an equal investment into sales, marketing, engineering, project management, which happens as well. And this has to happen in advance of the plants coming into production. So once you are in that cycle of increasing your turnover, increasing your output, then the expenses also start a little earlier. So I think margins should definitely go up. But since nearly every year we are trying to grow by 15 to 20%, there will be a little bit of a lag. And it's important for a company like ours. We are very fond of calling ourselves the Mercedes of pre-engineered building industry, and an industry which was pretty much unknown till a year and a half ago. I think it has come into a lot of prominence. I think the investment, we must realize, has to be in advance. And unless we invest into engineering and design and better quality, better deliveries, better erection or project management at site, we are not really a pre-engineered building company. We are not governed only by what we produce. So it's very important that we grow all around. And that is how we have grown over 25 years, step by step. This is not an industry which you can jump overnight. These figures, what we have got, I think are extraordinary. But otherwise, this is not an industry which you can jump too much, too fast.
Fair enough, Mr. Nanda. The intention of asking you that question was simply that since you mentioned that the second half is fairly predictable for you as a company, so you would have a better projection of what's going to pan out in the second half. And since your first half has been that good, it would only mean that the second half would be equally better, if not more. But be that as it may, what's your order inflow been for the year so far, FY26, the first 6 months? And how has the situation been on ground in the third quarter so far? We are into almost, a month and a half of the third quarter as well.
The order intake has been good. I think our order intake is very much related to how much we can deliver, because we cannot take more orders since pre-engineered building is a very short-term order cycle business. Nobody gives an order to us 2 years, 3 years in advance. Is maximum, even a very large order, is 10 to 11 months. So we have an order book of, let's say, 1,630 crores, which we will be having to execute in the next 9 months, 10 months. Of course, we'll try a little faster. So it reflects that, and it's very robust. We have booked about 450 crores of orders in the last 3 months. And I think it has to relate to our turnover. So I think our ability to take more orders increases with our ability to deliver more. So there's no problem. The pipelines are very healthy. I think, as your commentators have also mentioned in the last few days, few weeks, private sector investment is also improving. And in the sunrise sectors that we are there, in the new age sectors, as we call them, the renewables, the lithium battery, your data centers, electronics, these are growing at a very fast speed. And more are changing to steel, and more are changing to pre-engineered steel, because that is the best way to build fast and go forward. Right. So we don't see any problem, I would say, next 4 or 5 years, in any problem in the kind of business we are in. A lot depends on how fast we can move all our 4 legs. Yeah.
Got that. Mr. Nanda, we leave the conversation here. Lots of earnings to track today. Thank you very much for joining in. Get into a break. More on the markets when we return.
Welcome back. Good going for the indices. The Nifty still above the mark of 25,600. The Sensex to 450 points higher. The broader markets doing fairly okay for themselves as well. Take your leave on this edition of Trading Hour. From Rima and me, thank you for watching. Halftime report on the other side.